AI stocks have been powering the market higher, but not every investor feels comfortable with the pace of the rally. Are you an investor who is convinced valuations have gotten ahead of themselves, or do you believe that investing in AI is really just making a bet on the future? I'm Danielle Nuzzle with BMO ETFs, and in today's episode, we discuss how you can think about positioning your portfolio, whether you're excited about AI or you're more cautiously optimistic or feeling a little bit of FOMO or fear of missing out from the trade if it continues to persist. And as a reminder, today, Eric and I are not providing any investment advice or investment recommendations. Today's show and all our shows are about investment and ETF education for do it yourself investors. To help us break this all down and provide some insights on the subject is Erica Toth with BMO ETFs. She's the director and head of ETF and portfolio consulting. Erica, thanks so much for taking the time to join us on the channel today.
Thanks for having me, Danielle. Always a pleasure chatting with you. I was looking forward to today's discussion.
So, Erica, let's start with kind of like a big picture. Um, where are valuations today? What do they look like that's trying to driving these concerns with some investors that we might be entering a bubble territory?
Yeah, absolutely, Danielle. I would say that valuations are a common concern for investors right now. Our strategist Bipin Rai pointed out earlier this week in one of his research reports that if you look back 20 years for the S&P 500, you can see that where valuations are at do matter when you're looking at 12-month forward returns. So we have this chart up on the screen here. Given that the S&P 500 PE ratio is currently around 23 times earnings, this chart tells us that on average, the expected return should be, somewhere in the 4 to 5% range for the index this year. It's not a forecast, as we don't know what's going to happen in the year ahead, but it's definitely something to take into consideration as investors build out their portfolios this year. So as I mentioned, current valuations are high from a historical standpoint, especially when you look at the companies that have been leaders in AI. Most of the Magnificent Seven are trading at forward PEs above the S&P 500 average, which reflects higher growth expectations. But just to give you a few examples, Apple is trading around 33 times forward earnings, Microsoft 30.5 times forward earnings, Amazon close to the 28 times earnings mark. So, there are those concerns about multiples and even about concentration risk. So if you look at like technology and communication services, these two sectors now represent about 40% of the S&P 500 market cap, and the Magnificent Seven companies alone account for about 30% of the index's weight. So I mean, there's still the argument that fundamentals, if you look at cash flow, if you look at earnings growth, are supportive of these prices, but there's definitely some investors that are considering, what are how to allocate given this backdrop and given these valuations.
Thanks for setting the stage there and going over those PE ratios, certainly elevated over versus historical numbers. When investors are thinking about making a trade to get access to a theme like artificial intelligence or a sector like the IT sector, what are the benefits of using an ETF to get exposures to these types of areas of the market?
One of the huge benefits of using an ETF here, Danielle, is instant diversification. You're spreading your risk across a number of different companies rather than making a bet and tethering your fortunes to one. One of the other huge benefits is transparency. So you'll know exactly what you're holding within the ETF and what your exposures are. At BMO, we publish our full holdings lists daily to our website. And the third benefit would be the low cost of the ETF wrapper. So I would say those are the three main benefits.
Really good points you make there, especially when investors are thinking about something like AI. This is a growth theme. And, investors are always kind of thinking about the return side of the equation, but we always like to remind investors, you also have to think about how much risk are you going to take on for that expected return. And when you use an ETF, that diversification mechanism really helps manage your risk side of portfolio management and that equation. So let's talk about some different scenarios and different kind of investor sentiments around this trade right now, Erica. So there are a lot of investors who are still very bullish on the AI trade. So for those investors who are bullish or want to make a play on this, what kind of ETFs could they look to get exposure to this?
Yeah, so one of the instruments that they could consider within the BMO ETF lineup would be the NASDAQ 100 ETFs. So the NASDAQ 100 index is the 100 largest non-financial stock that trade on the NASDAQ exchange in the US. And from a sector standpoint, if we're looking at the exposures, you're currently just under 69% invested in information technology and communication services sector. So it's more of a pure play, let's say, compared to the S&P 500 if you're bullish on the AI theme. So if you look at the top holdings in the NASDAQ 100 ETF, the top holdings are the Bag 7. So they have a combined weight of 43%. NVIDIA currently being the largest weight, just under 9%. Apple just under 8%. Microsoft 7%. Alphabet 7%. Amazon 5, Meta's just under 4, and then Tesla just under 4 as well. So we have several currency options within the BMO ETF lineup. We have ZQQ, which is the BMO NASDAQ 100 equity ETF hedged to CAD. So this strips out the impact of the return of the US dollar versus the Canadian dollar. We have the unhedged version of that same index. Ticker is ZNQ. And this would take into account, the return of those 100 stocks as well as the return of the US dollar versus the Canadian dollar. And we have ZNQ.U, which is the US dollar purchase option of that same index. So for somebody that's still bullish and still sees legs to that theme, this would be a great way to play it. Another way within the lineup for investors that want really a pure play to focus on the technology sector and not have, consumer discretionary or communication services, these investors can consider our ZXLK, which is the BMO Spider Technology Sector Index ETF. This is 70 holdings. You have 3 out of those Mag 7 companies that are in the top 10. So you actually have an even heavier weight in NVIDIA, close to 14%. You have Apple close to 13%. You have Microsoft just under 12%. Collectively, those 3 names represent almost 40%. So that would be another option. And we also have a currency hedged version of that for those investors that just want the return of the companies and not of the US dollar. So if the investor anticipates that the US dollar is a little bit rich and might back up from here versus the Canadian dollar, they could look to purchase the ZXLK.F for the currency hedged units.
So for investors, for example, who might be holding S&P 500, if they want to tilt their portfolio a little closer to this AI theme or this AI trade, something like the Nasdaq, which goes from 500 companies in the S&P 500, now you have 100 companies, so more concentrated positions. Or you could even take that trade further and look at something like you mentioned, Erica, that sector spider tech sector exposure, now going down to 70 names. Thanks for highlighting all those tickers for us. So now for investors who might be a little more cautiously optimistic about the trade, they don't want to miss out on the trade if it persists, but don't want to take on as much risk as the full kind of Nasdaq or sector trade. What are you saying to those investors?
So there's a few options here, again, within the lineup, depending on what the investor's priorities are. One of the ideas that I would highlight for maybe somebody that wants to, take advantage and be in that theme, but take a little bit more of a defensive approach would be ZWT, which is the BMO Covered Call Technology ETF. So you'll own 30 of these largest US tech communications and consumer discretionary names. However, we are selling call options to earn additional monthly cash flow on the portfolio. So the current yield net of fees as of the end of last month is just shy of 5%. So it's 4.89%. And with this strategy, you're essentially turning volatility into a source of cash flow while still participating in the majority of the upside growth on those names. So here are some of the names in the basket. I put those up on the screen over here. Another approach, Danielle, would be blending something like the S&P 500 or the NASDAQ with something like ZLU, which is the BMO Low Volatility US Equity ETF. I would say that this would be a really good defensive way to make sure that you still are participating in the technology sector, still have exposure to some of those names, but with a little bit lower risk. So we have done some analysis. Some of the numbers that I've put up here on the next screen is an example of blending your exposure for U.S. equities, 50% in the low vol U.S. equities ZLU, and a 50% allocation to ZNQ, which is the NASDAQ 100 Index ETF unhedged. And we've compared how that's done versus just the S&P 500 index. So you can see since inception, this blend, this 50-50 blend, has actually outpaced the S&P 500, posting a return of almost 19% versus the S&P 500, which is just shy of 17%. And it's also done so with a lower volatility, with a lower amount of volatility, sorry. So that's where the total risk metric comes into play here. That's the standard deviation or the measure of volatility of that combination, that 50-50 blend versus the index. So we've reduced the volatility by combining the NASDAQ with the US low volatility ETF.
Thanks for telling us about that pair trade. I find it really interesting, and a lot of investors should take note that if you pair a couple ETFs together and you really focus on that volatility or that standard deviation, you can lower your portfolio risk while still keeping up with the markets and still participating. So thanks for highlighting that. What about investors who really want to dial back on their AI exposure altogether? Erica, what are you suggesting to them, or what are you talking to them about?
So one idea that I absolutely love is ZEQT. That's our BMO All Equity ETF. This is a terrific option because you're globally diversified across all the major broad indexes. We're certainly seeing a lot of flows over the last year going towards international equities, Danielle. And with ZEQT, you don't have to manage and rebalance individual positions. You don't have to decide on a regular basis, okay, what weight do I want for my international allocation, or thinking about, what's my US weight that I should allocate to. So in ZEQT, the S&P 500 accounts for approximately 45% weight of the basket, the S&P TSX Cap Composite 25%, MSCI EFI Index, which is developed international equities, 17% of the basket, and the MSCI Emerging Markets Index around 8.5%. And you do have a little bit of small and mid cap US exposure through the S&P 400 and 600 indexes, so just under 4% towards those. So this is a great solution for investors that say, okay, hey, I want to take a step back from, allocating purely to US. I want something that's broadly diversified. I want to allocate a little bit more to international markets. I think this is a really simple and clean way to do that, and to reduce your exposure to just the AI theme overall. Another thing that I would highlight, Danielle, and we talked, briefly about ZLU, which is the BMO Low Volatility US Equity ETF. The investors that really want to take a step back from AI and are concerned about the level of concentration in the US market could look at this. It invests in 100 names with the lowest beta out of the broad market. So these are companies that consistently have been less volatile than the broad index, and they're less exposed to the economic cycle. So you tend to see more exposure in more stable sectors, Danielle, like utilities, like healthcare, and it has provided steady long-term returns. The CTF has been around since 2013. And if you look at, as you mentioned earlier in our conversation, a lot of the returns over the last decade have been driven by technology stocks. So if you compare it based on just total returns over the last decade, ZLU is going to have underperformed ZSP because you don't have that technology exposure. To give you an example, the technology exposure in this basket is about 16.3%. So it's nowhere near the exposure that you have in the broad market. But as a risk-off play, I think it makes a lot of sense to consider. So even with this more cautious approach, Danielle, it has delivered really strong returns for defensive investors. So if you look at the numbers as of last month, the annualized return over 10 years has been 9.23%. So, you're emphasizing stability with ZLU, but you're still participating in market growth over the long term. Um, and, if you're worried about a repeat of 2022, when we saw a US equity market sell off that was driven by a sell off in the big tech names, ZLU was actually up 7.98% that year versus ZSP, which was down by 12.63%. So while, I can't sit here and say that past performance can guarantee future results, this track record has shown, how consistent and resilient these low vol strategies have been. Lastly, for more defensive investors, if we're talking about the low volatility strategies, if we look at a 50-50 blend of ZLU, the US low vol equity, with ZLB, which is our Canadian low volatility equity, this North American portfolio has actually not had a single negative year since inception. So ZLU, as I mentioned, the inception date was in 2013. ZLB, the Canadian strategy, 2011. So if you look since common inception, since 2013, there's never been a negative year of that 50-50 blend. So I think that would be a great option for defensive investors to consider, investors who are concerned about valuations and concerned about the possibility of a pullback and some consolidation in the AI theme. That would be one that I would certainly put on the radar, Danielle.
We talk about our low volatility ETFs a lot, and with their track record, like you said, Erica, investors can really see how they've behaved in different market cycles. Interesting about combining the Canadian and U.S. equity low volatility ETFs together with so far not a negative year yet. So investors who are thinking they still want equity market exposure, but kind of want to remove that those high voltage tech names out of their portfolio, great options. Thanks for highlighting those. Erica, for cautiously optimistic investors, we've also been hearing a lot about quality ETFs and quality investing. What can you tell us about that?
Danielle, I think this is another great option for investors to consider if they want broader US market exposure, but with a little bit of like a fundamental overlay to it. So our ZUQ, which is the BMO MSCI High Quality Index ETF, is a basket of 125 large cap US stocks. I would call it a growth strategy, but I would call it growth with a safety net. So the three screens that the index is looking for, we're looking for companies that are more profitable than their peers, so high return on equity. We're looking for companies that have stable earnings growth over time, so you won't tend to see a lot of cyclical sector exposures in there. But probably most importantly, we're looking for companies with strong balance sheets. So companies that have lower debt to equity overall. And information technology, because of these screens, is the highest weighted sector within that basket at about 32%. So that would be another way to play it with, a little bit of a more defensive tilt than going with, let's say, a NASDAQ exposure.
Erica, it was so great to have you on the show again. I hope we can have you back soon. Thanks for talking with us today.
Thanks so much for having me, Danielle. Always a pleasure.
And that's it for us at ETF Market Insights. We'll see you next week.